Hi there, Rob Pearlstone here from Remax Twin City, here with an associate of mine, Mark Benkovic from Excel Mortgage. Hi Mark, how are you today?
I'm great, how are you?
Good, thank you. I wanted to bring Mark in today and just ask him a few questions about the announcements that we've recently heard in terms of mortgage rates. And the first question I had for you, Mark, was we have all heard that mortgage rates recently increased. Can you tell us a little about that, please?
Yeah, they certainly have. We've had the Bank of Canada hinting for pretty well most of last year that they are thinking about raising interest rates because they didn't want the real estate market to get out of hand. They finally did raise rates about 2 weeks ago by 0.25% for the first time in nearly 7 years. At the same time, I've been watching long-term bond rates, and those have started to go up and stay up about 3 weeks ago. And that's equally, if not more important in terms of what's happened with interest rates. So basically, what's happened is this 0.25% rise in interest rates has resulted in the mortgage lenders pushing mortgage interest rates up almost half of 1%.
Okay, so as a homeowner, what would this mean to me? How does this translate?
Yeah, well, obviously, if you're having to refinance your mortgage at this point, things have gone up in terms of monthly payments compared to a month ago. A month ago, for a $100,000 mortgage over a 25-year repayment period, you would have been paying about $450 a month. Today, you're paying closer to $473 a month. So for every $100,000, monthly payments have gone up about $23 per month. Translate that into a $400,000 mortgage and your payments are up about $92 a month. For a first-time buyer, that might have the effect of lowering the price of the house that they can afford to buy in the first place.
Right, right. Okay, and in terms of what the future holds, I know you probably didn't bring your crystal ball with you today, neither did I. But historically, or going forward, what do you see sort of happening with the mortgage rates?
Well, I guess the true answer would be it depends. It depends on a lot of factors.
Okay.
First, when you consider that Canada, with about 35 million people, has less than 0.5% of the world's population at 7.5 billion roughly. What happens in the US, Europe, and Asia has a ripple effect back onto Canada.
Right.
So, on the one hand, the global economy is still fairly fragile, which is why interest rates are still relatively low historically, the lowest in our lifetime. But at the same time, as the economies start to show signs that they're improving, the government doesn't want people to get ahead of themselves and have what they call irrational exuberance, which we've already seen in the real estate market.
Right.
So they're trying to control things and mute things. And I can see the Bank of Canada sort of sitting back for a little while now and waiting to see what this 0.25% raise in the bank rate and 0.5% raise in mortgage rates, how that's going to play out in the real estate market in terms of sales. And if it doesn't have the effect that they desire, they're going to keep raising interest rates even higher. But I don't think we're going to see rates going lower from this point. They can only go higher.
Right, okay. And as a potential first-time home buyer, what sort of advice would you give me today if I were to walk into your office and tell you I want to buy a home, I make $50,000 a year, what would you recommend?
Well, basically on $50,000 a year, you're going to have a limit to how much you can afford. And first thing I would recommend is being realistic on the house that you can afford to buy and stay within that limit for sure. Secondly, if you can afford to raise 20% or more of a down payment, that's a big bonus because you're going to avoid a huge Canada Mortgage or housing or mortgage default insurance premium. So with a 20% or higher down payment, you can avoid that. And the higher your down payment, the lower your eventual monthly payments are going to be. Now, you and I were having a discussion not too long ago about how you bought your first house, and for peace of mind, you locked in at a 5-year rate, which I think is a great idea. Because over the last 9 years, mathematically, people were better off with a variable rate. But going forward, that's probably not going to be the case.
Right, and in my situation at the time in 2005, I was purchasing my first house on my own, and I wanted that consistency month over month, regardless of the fact that the rates were 4.6%, which may have been a little on the high side. at least I knew month over month what my payments would be, so I had peace of mind to know that every month this is what my mortgage rates would be, and I'd be able to adjust, adjust accordingly.
Yeah, and my advice as a former financial advisor, and from the standpoint of a peace of mind, a comfort factor would be the same. People ultimately have to choose what they're comfortable with, whether they're going to be risking rates fluctuating or not. But in general, I would say a first-time buyer was probably better off with the 5-year fixed rates and getting used to those payments over the next 5 years. And then if they could put extra funds into the mortgage, they could pay off that mortgage faster.
Of course. Nice. Great. Okay. Well, Mark, I want to thank you for coming today and joining us.
Thank you too.
And if you have any questions for either Mark or myself, feel free to contact us. We'll be posting our contact information after the video. Alternatively, you're welcome to comment on the Facebook comments below, and we welcome any and all questions. Thank you very much, and enjoy the rest of your day.
Thanks, Rob.
Thanks, Mark.